All right. Good evening, everybody. Nice to be with you again, finally. Thank you for everybody's emails and well wishes. You know, one of the things that I try to teach my kids is family first. And sometimes you never know when things are going to happen, and family first has to happen. So I appreciate everybody understanding and being as flexible as you have been over the last couple of weeks. Tonight, we are going to kind of pick up where we left off in terms of chapter 5 and time value of money, net present value calculations, how we translate the sales growth projections for a particular project, meaning incremental value added, okay, to the firm. How we translate those future streams of cash flows into present value dollars, and then how we go about creating a much more detailed discounted cash flow analysis. Because once we get through our first conversation, we're going to build out a full DCF with many more assumptions than we had at our last visit. We're going to get into the Heritage Doll case. And I'll tell you that, you know, it's not a complicated case, right? But there are some things that are nuanced that you're going to have to pay attention to, all right? You're going to be able to form groups of 4, no more than 4, please, to complete this assignment. I pushed the assignment out by 1 week. So it's going to be due, based on the syllabus, it'll be due on the same night that we run through the capital budgeting simulation. Okay, so having a whole extra week to do it just because of some of the slippage that's been my fault this last couple of weeks. But we'll get into the details of what that assignment looks like here in a little bit. So let's start talking about a more detailed discounted cash flow analysis and how we go about using everything that we've talked about up to this point, all right? Because we've got our midterm next week, okay? And the midterm is going to encompass everything that we've gone through tonight, okay? So behavioral finance, the basics of financial statements, right? How does retained earnings flow to the balance sheet? Okay, how do we build an income statement? What are the line items on the income statement, right? Once we get retained earnings moved over to the balance sheet based upon the information that we're given, how do we go about calculating the external financing needed, right? And then we need to make the plug, right? We got to have a plug variable, whether that's long-term debt or whether that's going to be common stock or whether that's going to be a change in the payout ratio. We need to understand the mechanics of how those two financial statements work together, okay? You'll have questions on the midterm next week that will relate to time value of money. You'll have a future value calculation, a present value calculation, a rate calculation, a number of compoundings period calculation. You'll have a PMT, so what's your monthly payment gonna be based upon some given variables, right? So you'll have 5 questions that relate to time value of money, you know, discrete from one another. You'll also have 2 questions that relate to project valuation, discounted cash flow valuation, okay? So like we're gonna build on what we talked about last time, okay? We're gonna get into how do we go about comparing one project to the next. That's what the Heritage Doll case is all about, right? The vice president of production of Heritage Doll Company is being faced with 2 different projects that she's trying to evaluate, mutually exclusive to one another. So you can't do both, you've got to pick one. Which one should she pick and why? And we'll talk about what the parameters are for that in further detail tonight. Okay, so that'll be the midterm, all right? Starting at the very beginning of the semester with behavioral finance, okay, some bias questions. We'll get into income statement develop, development. You'll be thrown a hodgepodge of information: revenue, net fixed assets, depreciation, interest, different expenses, salaries, research and development, okay, accounts payable, accounts receivable, but it's going to be presented to you in a very jumbled kind of form. And you're going to have to figure out what's an income statement item, what's a balance sheet item. You have to build the income statement, you have to build the balance sheet, okay? And then from there, you're going to move into developing a 10-year pro forma based upon a percentage of sales growth method. And here's where, if you're going to make a mistake on this, this is where you're going to make it. So everybody listen up. Remember that the project is what we're evaluating. We're not evaluating the entire revenue stream of the whole company. We're evaluating the incremental impact that the project has on the company. So you're going to be developing a whole company income statement, okay, for the entire business. But when we get into the project analysis, and it says that the project will add whatever, call it an additional 10% revenue, okay? The next, your project cash flow streams, your pro forma, your 10-year pro forma is only the 10%. It's not 110%. So it's incremental. And if you're going to make a mistake, that's one of the places that you're going to make it. Okay, so remember, it's bolded, it's underlined, and it's all in caps. It'll say it on the midterm. It's incremental, right? And then we'll get into project comparison, evaluation, and then why you selected one project over the other. In terms of when you will have the time to take the exam, normally we'd be doing this in the classroom, and you'd have 3 hours from 6:30 to 9:15 to take the exam, right? We're not going to do it that way, right? I will post the midterm, okay, next Monday at 9 o'clock in the morning. Okay, it's a written case study, so it's not on Connect. It's not on Connect. It'll be posted on Moodle. Okay, it'll be a Word document with all the information that you need. Okay, I'm going to post it at 9 a.m. right? And you'll have until 9 a.m. Tuesday morning to submit it via Moodle. Okay, and details around what you need to submit will be put onto Moodle. Right? So everybody feel okay with that? Everybody think that's a little fair?
24 hours, yeah.
Okay, so you have 24 hours instead of 3 hours, and you won't have to do it between 6:30 and 9:30 at night. How about that? Again, the only thing I ask is that, don't use your neighbor or your other classmates to do the work yourself. I don't have to worry about that with you guys. My undergrads are a totally different story. Jesus Christ. I actually literally had somebody cheat on my midterm that I gave last week. And not only does that just really piss me off and send me into orbit because I don't raise my kids to do anything like that, but it creates such a hassle in terms of having to deal with academic honor boards, and they have to go in front of the honor board. It was just a complete and total disaster, so I love you guys. I love my grad classes because, we're all mature adults here. Okay, so let's go ahead and get into tonight. Like I said, so the subject matter that we're going to talk about tonight, okay, is kind of scattered throughout 3 different chapters in the text, right? Chapter 6, chapter 9, chapter 11. But I'm going to bring it all together in kind of a larger example that I'm going to cut over to here in a second. And we're strictly going to use Excel tonight, all right? Because everything up to this point, the slide decks have been great. You can get the very discrete pieces of information. You can understand how the income statement and balance sheets work together. You can understand the basic time value of money calculation, future value equals present value times 1 plus the rate raised to the time period. AKA future value equals present value times discount factor. You can read all that through the slide decks. But when we start bringing everything together and we start talking about, that's great, but how do we evaluate a project given capital constraints that we have as a corporation? Okay, we're going to be talking about all these different chapters all at one time, right? So tonight we move from the very discrete conversation around time value of money into, now we take that time value of money conversation and apply it to a real scenario, okay? And how businesses go about using discounted cash flow analysis to figure out how much they'd be willing to pay for a company they might be looking at acquiring, okay? Or how they go about allocating their capital expenditures that they have allotted for that given planning year, okay? So that they use their capital in the smartest, wisest, most efficient way. So I've built an Excel file, a little scenario here for us to kind of start walking through. And we'll go through it slow because there's a lot of assumptions that we are now going to be making. So Annalise, I think you mentioned that, you wanted to see maybe a little bit more detail around how people go about forecasting, because maybe it's not straight line every single year. And I promised not to hose you guys on the midterm by giving you some sort of like crazy, wacky growth rate shape. Okay, and I'm not going to do that. But I did kind of want to go through an example here of what your businesses look at on any given year. So in this case, we're going to be evaluating kind of, we'll call it a marketing promotion, okay, where we're going to look at what kind of new market penetration we might be able to obtain, okay, if we invest $50,000 of capital money. That's cash, it's money coming out of our pockets, okay? If we invest $50,000 and we're putting money into a market size that's roughly $5 million of market size, and we're going to do a 5-year projection, okay? And within each of these next 5 years, each year we've got some sort of incremental market penetration rate. Okay, so in year 1, we're going to penetrate the $5 million market size by 0.5%. Okay. In the second year, in addition to the year 1 market penetration rate of 0.5%, we're going to add to that another 0.65%. Right? So on and so forth until year 5, where in year 5, we're finally going to be adding incrementally, okay, another 1.75%. So in total, we will have penetrated the market by a total of 5% in this analysis that we're going to be doing. Okay, but it creates different layers of revenue, and we'll walk through how to build that. Right? We need to pay some royalties. All right, so it looks like we're licensing some products from some other folks who own the rights to the product. So we are going to have to pay out 25% of our revenue stream in the form of a royalty. Our cost of goods sold for the product that we're going to be putting out into the market is roughly 30% of our revenue. So what you see here, I'm going to go through each one of these, but what you see kind of in this table, in this assumptions table, is going to be very similar to what you're going to see on the midterm, okay? In terms of verbiage, the number of assumptions, how the assumptions get used, very, very similar to what you're going to see on the midterm. Expenses as a percentage of revenue, okay? We haven't put the project in place yet. All right. However, in order to get the project put in place, we're going to have to spend $5,000 for research and development. Right. So it's cash going out before we have any cash coming in the door. From a balance sheet perspective, we're told that We have net fixed assets of $150,000, and we're told that depreciation as a percentage of net fixed assets is 4%. So on the income statement, now we know how to calculate depreciation, 4% of the net fixed assets. Okay. We're given some information about long-term debt, right? If we're thinking about the income statement, why do we care about this? Why do we need this information right here if we're talking about the income statement? What can we do with this information? We're told what the principal amount is. We're told what the interest rate is. We're told the number of periods, and we're told how many times it compounds every year. Using those 4 different variables, what can we calculate that's very, very, very important on the income statement?
Your interest expense.
Interest expense. Okay, exactly right. Thank you very much. Okay, now, if we were doing this in the finance department for each of your respective companies, all right, we're going to talk a little bit about, I'm going to ask you what the fundamental flaw in the way we're going to do it for this class, what the fundamental flaw is, all right? But keep in mind that what Julie just said is exactly right. We can use this information to use the equals PMT formula within Excel to calculate what the annual interest expense is going to be for this particular project, and repayment of principal as the case may be. You're going to be given a tax rate. You're going to be told what net working capital as a percentage of sales looks like. Okay. What is the initial net working capital for the project required? Okay, so we've got to put money into the business to keep the day-to-day activities of these projects running, right? Is there any ongoing capital expense for the project? Even though it costs $50,000 to implement, are there any ongoing capital expenditures that the project is going to incur? That's cash. Okay, we have to account for that cash outflow when we start looking at the free cash flow calculation for the project. And then finally, like we talked about as it relates to the time value of money, what's the discount rate? What's our hurdle rate? What's our weighted average cost of capital? What's our cost of capital? All of those things are referred to as the discount rate. Okay, when we convert those future dollars into present value dollars, okay, we use the discount rate within that calculation. Okay, so what's the first thing we have to do? With this information that you're given here, what's the first thing that we need to do? It involves this. Any ideas? What's the very first line item on the income statement?
Revenue.
Revenue. We got to calculate what revenue is for those 5 years, right? So let's do it. All right. So we know that in year 1, okay, in year 1, we have a total market size of $5 million. Right? And we know that in the first year, we are going to penetrate that market by 0.5%. So our revenue stream is going to be 0.5% of the market size. So the year 1 penetration revenue in year 1, so think of this in layers, okay? You have incremental layers of revenue that are coming in the door based upon each year's incremental market penetration rate. But in year 1, we've only got the year 1 penetration rate that equates to the year 1 realized revenue. So in year 1, a realized revenue, what the actual revenue is as it results from the project, It's simply nothing more than the 0.5% times the market size. Okay. So in the first year that this project is in operation, we've penetrated the $5 million market by 0.5%, which means our revenues have been derived as $25,000. And every year from year 1 to year 5, we're going to keep getting that, because remember, we're dealing with incremental. So the year 1 realized revenue is the year 1 penetration revenue. But then in year 2, okay, we still have what we did in year 1 carrying over to year 2 as kind of the base load, okay, the backlog, if you will, of revenue. But we add to it with the year 2 incremental penetration. So in addition to what we did in year 1 at 0.5%, now we're adding to that another 6.5%, 0.65%, sorry. Okay, so the year 2 impact on the year 2 realized revenue is 32,500. And so our total realized revenue in year 2 is the layer of revenue that we got from the work that we did in year 1 that carried over to year 2, plus the work that we did to grow our business by an additional 0.65%. Okay. So our year 2 realized revenue is the combination of the year 1 penetration revenues plus the year 2 penetration revenues. Okay. And if anybody wants me to slow down and stop, hit the chat room or speak up, and I'm happy to go back and review this again. And those year 2 revenues continue on for the remainder of the project. So we're creating layers of revenue streams based upon the work that we've done in prior years. Year 3, same thing, 0.85% of incremental on 5 million, okay? That creates the third layer of revenue within year 3. So our year 3 revenue is now $100,000. And so on and so forth until we get to year 5, where we have the year 5 penetration rate times the market size, and then we've got year 4 layer, year 3, year 2, year 1, all adding up to our total revenue, total realized revenue projection of $250,000 for the project. Okay. And if we look at the $250,000 and we divide that over $5 million, okay, we see that that's the same exact 5% market penetration rate that we obtained, okay, when we looked at the different layers, okay, except now we're showing where the layers of revenue are coming from. Okay, so we've got revenue, right? So now if we're moving through our income statement, we've got to deal with the expenses. We got to get down to EBITDA, right? So we've got things that are costing us money. Most notably, cost of goods sold at 30% of revenues. So cost of goods sold, 30% of revenues, 0.3 times the revenues, right? So we build that out. It's the same formula. So once you do it once, copy it and then paste it everywhere else. We know we've got royalties as a percentage of revenues at 25%. So we bake in the royalties, okay, 25% of the revenues. Again, copy, paste. Expenses. We're told that expenses are 10% of revenues, okay? 10% times the revenues. Copy, paste. So that's for the project, right? Now, why do we have something in here at time 0? Like the project hasn't really started generating revenue yet, but why do we show that we've got an expense?
Initial R&D.
Yeah, initial R&D. So we're shelling out money because we want to get the project off the ground. And in order to do that, we've got to use some cash. So in time zero, we're told that we have initial R&D of research and development of $5,000. So we've got an expense in time at time zero that relates to the project, and that expense is $5,000. Okay. And then as we move through the remainder of the income statement, depreciation, we are told that depreciation is 4% of the net fixed assets, okay, for the project. Done, right? EBIT is EBITDA minus depreciation. We've got that. Now we calculate our interest. So how do we go about calculating the interest, right? Or the money that we're going to pay out on our debts that we owe, right? So has anybody used the PMT function before in their work? Mark, you have?
Yeah, I have.
How are you using it?
I'm in mortgage-backed security, so I use it to, back into mortgage payments.
Right. So in your line of work, right, what are the other two functions in Excel that are really important in like the mortgage world that relate to the principal and the interest?
It's, you need your rate and your, I guess, present value to get back to however much the mortgage is going to be.
Right. So you can use the equals PMT function, right, to calculate what the total payment is going to be, right? So the equals PMT, when we do this, and I'm going to walk through it here in a second, that's going to tell you what the total payment is. Okay. So in Mark's world, if you're dealing with a mortgage and you've got, $125,000 loan at 3.5% for 15 years that compounds monthly, the equals PMT is going to give you the total monthly payment for that mortgage. Okay. Or in this case, the total monthly, now converting it to annual payment for the debt service for this company. Okay. What's the flaw in using equals PMT in this analysis? What does that payment include? If we think about the mortgage business and we think about what we pay for our mortgage every month, what does that monthly payment include? It includes two things.
Principal and interest?
Principal and interest. Thank you, Morgan. So the number that we calculate here isn't pure interest.
Right.
Okay. It's a combination of principal and interest. All right. Now, what I could do is I could change this to IPMT. Oops, hold on. But then I'd have to go and change. Oh, they flipped the formula around. Crap. I'll come back and do that. Right? But for this class right now, we're just using the PMT. But there are two other functions within Excel that you can use to calculate what's the principal component and what's the interest component, right? IPMT, interest payment, and PPMT, principal payment. Okay, or it could be equals PRN. I think they actually changed it. So let me just look at it real quick.
Yeah, it's still P payment.
It's still PPMT. Okay, so you can break this down if you wanted to. We could break this down instead of just using the equals PMT. We could break it down into the equals IPMT purely from an interest standpoint. Okay, but for this class, we're going to keep things a little simple and just use the equals PMT function. Okay, so when we look at the equals PMT function, it tells us what we need. It asks us for our rate as the first variable. Okay, so let me just redo it here. So equals PMT. Okay? So it asks us for our rate, and in the example, it tells us what our rate is at 3.5%. Right? But it also tells us that it compounds monthly, so we got to account for that. So we divide by 12. Okay? Tells us asks what number of periods, how many compounding periods do we have? Well, we got 15 years, but there's 12 compounding periods per year because we're on monthly compounding. So 15 times 12. Okay. We know the present value of The loan is $125,000. So remember, it's cash out, so minus 125. Okay. And what's the future value of a loan? Zero. You pay it off, right? You pay it off. At the end of the 15 years, the loan's paid off. So there is no future value. So we can close it out. Okay. Oh, gee. Well, that's different than 4394. What do I have to do with this now? So remember, equals PMT, 0.035 divided by 12. Okay. We got 15 years times 12 compounding periods per year. Okay. And we've got a PV, okay, of $125,000. Negative 125. Okay. What do I have to do to this number? Is this a monthly number or an annual number?
Monthly.
Monthly. So we got to multiply by 12, right? Okay. So we'll carry that out. Okay. All right. So now that we've got the interest payment, now we can get to EBT. We can calculate taxes. All right. There are no taxes since we have negative earnings. If you were speaking with your CFO and you had negative earnings, you could possibly take advantage of something that's called an NOL, net operating loss, okay, where you could roll forward that loss into a future year to offset future taxes. We won't get into that here in this class, but just know that if you have negative EBT, you won't owe any taxes and you'll have negative net income. Okay. So once we've got the taxes calculated at 21% of EBT, all right, then we can just roll forward the formula and it will do the work for us. All right. So when we look at the income statement for this particular example, all right, we've got net income, we've got EBITDA, we've got a tax calculation, okay, and we've got some information here that relates to net working capital. All right. So the next step in the discounted cash flow process is we need to figure out how does net working capital impact cash? And we've talked about net working capital as the difference between current liabilities, current assets, and current liabilities, right? So when we have a change in net working capital, right, that's actually either a source of cash or a use of cash. Okay, so when we think about free cash flow, right, we have to look at what is our EBIT, right, minus our taxes, because taxes are obviously a cash flow item. So what's our tax adjusted EBIT? So EBIT minus our taxes. Clearly we have to add back depreciation, right, because that's a non-cash item. And then we subtract out the change in working capital year over year, okay? Because that impacts our cash flow, okay? If we have an increase in net working capital year over year, it means it's costing us more money to run our business. So we have less free cash flow on hand. And then we have to also then back out the cash that we have to spend to keep the business running. So when we talk about free cash flow, all right, we're looking at our tax adjusted EBIT plus depreciation minus our change in net working capital minus the capital expenditures that we have to shell out every year to keep the project running. And that gets us to our free cash for the business. So when we look at it from this project, okay, we've got our tax adjusted EBIT. We have EBIT of $2,750 minus our taxes. Well, guess what? We have no taxes, so it is what it is. But in year two, we've got EBIT minus our taxes gives us our tax adjusted EBIT. Okay, so we've taken into account the cash that has to go out the door to pay Uncle Sam. Okay, and we continue that on through year 5. Okay, now we have to go back in and add depreciation for every year. Okay, so we've got the tax adjusted EBIT. We add our depreciation back in because that's what we know that number. We've calculated the change in net working capital. So our net working capital, we were told, was initially it was $1,000. Okay, and then every year after that, it was going to be 17% of the sales number. So the actual raw net working capital numbers are $1,000 at time 0, and then 17% of the realized revenue for the year. Okay, so those are our raw net working capital numbers for each year. And then we have to calculate the change. Okay, clearly the change in years at time 0 was 1,000, right? Because we hadn't done anything prior to that. So the change is 1,000 more than what we had in time -1. And the change in net working capital from the moment we decided to start this project up to the end of the first year, okay, was what our net working capital was at the end of year 1 minus the beginning, or 3,250. And we do that change year over year until we get out to year 5, okay? So we're looking at how much extra money is this project costing our business from a net working capital standpoint every single year, right? So free cash flow, tax adjusted EBIT plus depreciation minus the change in net working capital minus the capital expenditures that we have, free cash flow. And we do that for each of the 5 years of the project being in operation, as well as the very first time period where we have to spend the money to implement the project. So at time 0, we had to spend $5,000 on R&D. We had to spend $1,000 to, inject working capital into the business to get the project running for the day-to-day activities. And then we had to spend $50,000 for the project itself. And then finally, where did the CapEx from years 1 to 5 come from? We were told right here in the assumptions that the annual CapEx for the project was going to be $6,500 a year. Okay, good question. Sorry if I didn't make that clear enough. Okay, so that was part of the assumptions. It's all right, Will. I may have neglected to mention where that came from. Okay, so you're going to be told what that is, right? Or you could be told that the annual CapEx requirement is that you're given a certain amount of money based upon the EBITDA for the business in any given year. So when we get into the Heritage Doll simulation, okay, that's how it's going to look. Your capital expenditure allocation is going to be tied to the percentage as a percentage of EBITDA for any given year. Okay, so, but you'll be given information around what the annual CapEx requirements are. Okay. So we've got our free cash flow numbers now. Okay, so just like we talked about last week, where we said, when we're looking at using the operating cash flow as our first metric of free cash for the business to use against the discount factor to then bring those future values into present values, right? That's what we're doing here, except we're just kind of taking it to the next step and adding in the other 2 remaining cash flow items that impact free cash flow: change in net working capital and the amount of CapEx that you're going to be spending every year to keep the project running. Okay. So step 1 is to calculate the free cash flow, right? Which we've done here. Tax adjusted EBIT plus depreciation minus change in net working capital minus CapEx, free cash flow, okay? And remember, these are future dollars. These are all in kind of future dollar form. So the next step, naturally, if we're going to try to get down to what the present value of these future cash flow streams look like, we've got to revert back to the future value formula. future value equals present value times 1 plus the rate raised to the number of periods, or what period that you're in. So we have to take each one of these future cash flow streams in future dollars, okay, and bring it back into today's dollars. Okay. So step two is we have to calculate what is the discount factor for each one of these years. Okay. So future value equals present value times 1 plus the rate to the time period. Okay. When we rearrange that formula and we say present value is equal to the future value divided by 1 plus the rate raised to the time period, we can split those two things into two pieces. And now we can say present value is equal to the future cash flow stream multiplied by the discount factor. And the discount factor was 1 divided by 1 plus the rate to the time frame. So we take the discount factor, we're told what the discount rate is, we're given the rate, and we calculate the discount factor as 1 divided by 1 plus the rate, okay? 1 plus the rate, right? Raised to the period that we're in. And in this case, we're in period 0, okay? Which means that we're not going to get a discount factor other than 1, right? We don't have to discount it because we're in that very first 0 period, okay? And then if you've linked up your Excel file the way that you should be able just to drag that entire formula across, and it creates your discount factor for the remaining 5 periods, okay? Once we know the discount factors, now we can calculate the present value for each one of those time frames, right? So step 3 is to calculate the present values, okay? Present value is the future value times the discount factor. And you do that for each one of the 5 years, okay? And we get the present values. Now we've got every single period discounted back into today's dollars so that we can now compare the present value of those future stream of cash flows to how much money we've got to shell out today in order to generate those cash flow streams. Okay, so step 4 is to calculate the net present value. Right? So when we sum all of the present values discounted, let me rephrase that. When we sum all of the future cash flow values discounted back into today's dollars using the appropriate discount rate, we come up with the net present value of the project. Okay, so we spent $56,000 of our money today. That $56,000 was cash out the door. And by doing so, the new project incrementally added $77,156 present value dollars to our business. So we spent $56,000 present value dollars today. We're forecast to generate $77,156 future present value dollars, okay? And when we add everything together, it tells us that the net present value is a positive $21,156. Okay? And what we said was, if we're looking at the criteria within which we evaluate whether or not we do a project or not, whether we accept the project, whether we spend our capital on the project, we said in general, if the net present value is greater than 0, then we accept the project because it delivers incremental value to the firm above and beyond above and beyond what we would have received had we taken that $56,000 and simply invested it at 8%. Okay? So calculate the net present value is step 4. Then we're going to take it one step further tonight, a few steps further. We calculate the internal rate of return. Okay? So the internal rate of return within Excel uses the undiscounted cash flows, right? Because the internal return, right, this is important, the internal rate of return is the discount rate that would be required in order to set the net present value to 0. Okay? So how much, what we're looking at in this project is how much more return am I getting on this project over my next best alternative, which would have been just simply to invest the $56,000 at 8%. So when we do the IRR, we're using the undiscounted cash flows because Excel is going to be using the undiscounted cash flows to figure out what rate of return is required to force the net present value to 0. And in this case, when we do that, we bring down, okay, the undiscounted cash flow stream from our free cash flow, okay, and we simply use the equals IRR function for those undiscounted cash flows. And when we do that, Excel gives us an answer of 16.8%. So let's see if you got the gist of IRR. If I changed the discount rate here from 8% to 16.75%, what does my NPV of the project go to?
0.
Goes to 0, okay? Because the internal rate of return is the return that's needed in order to set the net present value to 0, okay? So what many times what your companies are gonna look at isn't necessarily the raw internal rate of return value, because you're gonna be evaluating, you know, hundreds of projects potentially, okay? And within that basket of projects, you're gonna have some risky projects, you're going to have some less risky projects, you're going to have some moderate risk projects, and the way that that risk level is accounted for within the net present value analysis is with the discount rate, okay? You're going to have potentially different discount rates, different hurdle rates, different costs of capital, depending upon the level of risk that your project is requiring you to take, like we've talked about. You should always be rewarded, okay, for the level of risk that you're taking, okay? If you're taking too much risk and you're not getting enough reward, well, that's a dumb idea, right? Just like in the stock market. If you're investing in an individual, very small biotech firm with a very high standard deviation, your possible expected return ought to be really high, because you're taking a lot more risk investing in that small biotech firm, and you're going to deal with a lot more volatility than if you invested your money in Pepsi or Coca-Cola. Okay? So this is how we adjust for the risk within certain projects. And when we get to the Heritage Doll case, we'll see how their board of directors and their management team and their treasury department has assigned different discount rates for varying levels of risk, okay? So yes, thank you, Jennifer, that's exactly right. If we set the discount rate equal to the IRR, then our net present value will go to 0. So if we change this to, well, let me just do it exactly. So I'm gonna copy it and I'm gonna paste it as values, okay? We see that the net present value goes to 0, okay? So that is the purpose of the IRR. So what many of your companies will do is, instead of looking at the raw IRR number, they'll look at what's called the spread to WACC, or the difference between the IRR and your discount rate. Okay. Because there are going to be times potentially when you're evaluating two different projects at two varying risk levels, where your net present values might wind up being like really close to one another. Okay, they could be really similar, right? But you've got two different discount rates based upon the level of risk. So now what you have to do is say, all right, I can't really make a decision per se on which project that I'm going to implement solely based on net present value. So I'm going to move to IRR, right? But I don't necessarily care about the raw IRR. What I care about is the spread to my cost of capital, right? And I want to choose the project that has the higher spread, because that's delivering even more value to the firm. Okay, so we calculate the IRR, but another variable to consider is the spread to the WACC, the spread to the cost of capital, the spread to the discount rate, because there will be times when you're doing your capital budgeting that you're going to have two projects that look really good, that might have similar net present values, but one's going to have a larger spread. Okay, and barring anything else, any other projects that you might be looking at, you're going to look at the one that's got the higher spread. Okay. So step 5 is to calculate the internal rate of return. Step 6, we're going to talk about payback period. Okay. This is not a metric that is used or should be used in the determining factor of whether or not you accept a project or reject a project. It is simply another data point to use in the analysis, right? So we're going to be using what's called the discounted payback period, where we take the discounted cash flows, so present value cash flows, because we want to compare apples to apples, and we want to see how long does it take us, okay, to pay ourselves back for the initial investment that we put into the project. So in this case, we shelled out 56 grand at time 0, and that $56,000 generated a future stream of discounted cash flows. Okay, so the present values, right, from what we had already done above here. Okay, and now we have to keep track of how are we doing paying ourselves back. So we have to keep track of the cumulative cash flow, right? So the cumulative cash flow is simply nothing more than what the balance was at the beginning, right, minus whatever we put into it from the cash flow stream that we generated. So actually in year 1, we lost money, so the balance got more negative. But in year 2, we started to make money. We made 6332. Therefore, our new balance at the end of year 2 was what we started year 2 at 56,926, minus what we paid down of 6332 to get us to a new balance of 5594. So we're keeping track of that cumulative pay down of the money that we initially shelled out on a discounted basis. Very important, right? And then once you have that formula, you can just simply click and drag all the way out. And what we're looking for is where it crosses over. Where do we go from still having a negative balance at the end of a year to the next year where we have a positive balance, meaning we've paid off our loan, okay? We've paid off the initial capital outlay for the project. And in this case, we see that at the end of year 4, okay, we still had a remaining loan to pay off. We still had $13,732 of our initial investment that was remaining that we needed to pay off. But at the end of year 5, we had actually paid it off, and now we've got $21,156 that we're in the black on, right? So we know that we paid off that whole loan. We repaid ourselves somewhere in year 5, okay? Because we still had a balance at the end of year 4, it's negative, and we know we paid it off because now we've paid that down, and now we have positive territory on the cumulative cash flow. So how do we figure out exactly where in year 5 we paid this off? Okay. Well, we know the first part of the payback period is 4 years. So we know we have a payback period of 4 years and something. Okay. And we know that at the end of year 4, we had $13,732 left to pay. Okay. And we know that in year 5, we're forecast to generate $34,888. Okay. So how do we do it? Well, what percentage of the year, how long in year 5 did it take us to generate $13,732? Well, it's pretty straightforward. We take the remaining balance that we had, the $13,732, we divide it by the full year discounted cash flow for year 5. So it gives us a percentage of the year that it took, okay, to create the $13,732. Okay. And then we multiply it by 12 for the number of months in a year. And then it tells us it took 4.72 months of year 5, okay, to get us to a payback of 0. Okay. So the total payback period for this project is 4 years, and 4.72 months. Sorry. I changed a few numbers around from what I had done before. So in 4.72 months. Okay. So that's the payback period. Okay. And then finally, the fourth metric that we're going to look at when we get into the Heritage Doll case is what we call profitability index. All right. How many incremental dollars is this project adding to our business, okay, on a discounted basis? So the profitability index, right, is nothing more than the sum of all of the present values of the project, that's being the sum of the present values that are being delivered to the project, okay, divided by the initial capital outlay. Okay, so this project is delivering 38 more cents for every dollar that we're putting into the project. Okay, so it's delivering 38% more than what the capital investment was put in. Okay, 38 more cents on the dollar. So we take the sum of all of the cash flow streams on a present value basis, and we divide that by what it cost us to put into the project. Gives us the profitability index. Okay, so in terms of how we go about using these metrics to select one project over another, and keep in mind that we're operating under the assumption that these projects would be mutually exclusive to one another. I mean, you can only do one, you could not do both. Okay. Then the order of operation, if you will, in terms of how we go about selecting it is which project has the higher net present value, period. Okay. Second order of operation, if the net present values are relatively similar to one another, then we need to look at the spread to WACC. Okay. Which one is delivering incrementally more return to the business? Okay. That would be the spread to the weighted average cost of capital. And then we have these remaining two metrics that are not used per se in your decision-making process because they don't really factor in the future time value of money, right? But they are metrics that are used in order to support the decision to select a project based upon the project's net present value or spread to the WACC. Okay, so it's important to know what these numbers are, okay, but definitively we're using net present value as the first criteria, and if the net present values are similar to one another, then we use the spread to WACC as the second and defining criteria to select the project. Okay, and so here's the thing, right? This is a really simple example, right? And for those of you that have done maybe discounted cash flow analyses for the companies that you work for, all right, you're going to look at this and you're going to see some obvious differences between what I'm teaching you here in this course and the way that your company might go about creating DCF analyses, right? And this is the most frustrating part, is that every company is going to be different, right? Some companies will include depreciation in the calculation and not remove it. Some companies will put things in production costs that other companies don't, right? But the general idea is nonetheless the same. The goal is to get to free cash flow, okay? Once we get to free cash flow, then the methodology becomes almost identical from company to company. We have to take some future stream of cash flows and we have to bring it back into today's dollars using the discount factor, okay? And your companies are going to have different weighted average costs of capital. You're going to have different required rates of return, different discount rates, but nonetheless, you're going to be provided with that number by your Treasury Department, okay? Based upon the level of risk that your project poses to the firm. So you have free cash flow now. How you get to it, you know, whether it looks exactly like this or whether it's, you know, a hybrid of this or whether it's a mismatch or whether it's not even this at all, and your company has a totally different way of calculating free cash flow, nonetheless, it doesn't matter. The entire goal is to get to the free cash flow. What is the future projection of cash being derived from the projects that we are evaluating? And once we know that number and the Treasury Department gives us a discount rate, we can calculate the PV, we can calculate the net present value, we can calculate the internal rate of return based upon the free cash flows that we've got, okay? And we can then make a decision on the projects that we're going to take on. Okay, so what we're talking about here is the simplest, most defined way to go about creating a discounted cash flow analysis in order to select one project that's going to receive your capital allocation based upon a collection of mutually exclusive projects, okay? So there we are. So let me stop there for a moment to field questions from the floor. Anybody have any questions? Anything not make sense? And I'm surprised nobody's asked the question of whether or not I'm going to put this out on Moodle or not.
Are you going to put that out on Moodle?
Go, Morgan. There we go. All right. Bonus points. Bonus points.
What do they say? Closed mouths don't get fed, right?
Yeah. So I will post this on Moodle. Okay. I will tell you that in terms of the midterm, all right, we are not going to be getting this complicated. Okay. In terms of how we go about calculating the free cash flow, we're going to stick with using the operating cash flow methodology. right? So we're not going to be bringing in change in net working capital or CapEx, okay? The operating cash flow that we're going to be using for the midterm, the free cash flow, if you will, is simply going to be EBITDA minus taxes, which is what that is, right? Tax adjusted EBIT plus depreciation is EBITDA minus taxes, okay? So we're going to be using what we talked about last week from the operating cash flow standpoint for our future value. So it's not going to require the level of complexity that we just went through here. But the reason why I went through this next layer of complexity is because now when we start switching over to change gears to the Heritage Doll case, we are going to be bringing in change in net working capital and capital expenditures into the equation. Okay. So any other questions about this? Everybody understands the layers of revenue and how the revenue gets realized. Okay. All right. All right. Let's start talking about the Heritage Doll case. Okay. And let's look at the case itself. So the case isn't too long. All right. I think it's only like 8 or 9 pages. Right. Yeah, 8 pages. Okay. And what we're faced with is pretty classic, pretty typical of the capital budgeting process that your firms go through every single year. Every year, your businesses take some of their cash, take some of their retained earnings, and they invest it in projects that are designed to either add revenue to the business or cut costs. One of those two things, right? Both of which, if you're successful in doing both of those, you increase your net income even more. You increase your net income, increases your earnings per share. Increase on your earnings per share at the same price to earnings ratio pushes your stock price up, meaning you're adding more shareholder wealth to the firm, which is exactly the whole point of being a financial manager. Our whole entire goal is to maximize shareholder value, right? So if we can add revenue and cut costs, then we are successful in doing that. In addition to managing our inventory turnovers and how we manage our leverage, the DuPont identity, if you remember that, okay? But nonetheless, capital budgeting is an important part of the process, right? And this company, the New Heritage Doll Company, I know this case looks old, it's like 10 years old, but it's still 100% relative to everything that we're doing today, right? So we have this lady, Emily Harris. I'm sure she's a very nice lady. She's the vice president of the production division, right? And she's being faced with a decision. She's got 2 projects that she's looking at spending capital money on, and it's your job to go in and figure out which project she should do and why. Okay, that's the objective. Okay, you're given some information about the doll industry as a whole, and there's some important pieces of information here that I want you to take your time to think about. Okay, if the total toy and game industry was going to expect it to grow by 4.6%, okay, and Heritage Doll Company was growing at 9 or 10%, then one might suppose that that growth rate for Heritage is probably not sustainable in the long term. Could be sustainable for 1 year, maybe 2, but it's probably not sustainable for the long term if Heritage is operating in a mature business sector, a mature industry like the toy and game industry seems to be, since the growth projections for the sector as a whole are only 4.6%. Okay, so as you're reading the case, think about that. Okay, the doll sector, U.S. retail sales of dolls in specific, more applicable to Heritage as a company, only projected to grow by 3%. Okay, So as you're reading through, again, read it and start to noodle on what this means as it relates to Heritage as a company. Okay. You're given some information around the company, where they operate, the total number of employees that they have. You're given some information around the production division in specific, okay, and where the revenues are coming from, okay? Then we start to get into the capital budgeting process that Heritage uses, right? Their budgeting committee. Who's on the budgeting committee, all right? When you start providing some commentary within your written analysis, think about the importance of having this collection of people on the budget committee and why it's important to have the members who are here in the different parts of the business that they oversee within the budgeting committee for the allocation of capital. Okay. You're told about the capital budget. Okay, that's about 15% of the company's EBITDA. Right? When we get into the financial analysis, they talk to you about how they go about evaluating projects. They look at calculations of net present value, calculations of internal rates of return, payback period, and other investment metrics, aka profitability index. Okay. It goes through how they assess what discount rate to apply to varying level of risk projects. It talks about medium risk projects in 2010, where they received an assigned discount rate of 8.4, all right? High risk and low risk of 9 and 7.7 respectively. That's a hint, big hint, okay, as to when you start developing your net present value analysis as to what rate you're going to use to discount, okay, those future value streams back into today's dollars. Okay, it talks about a terminal value for the business. Okay, we got into the value of an annuity as a perpetuity. I think it was probably maybe two lectures ago. Okay, and they give you some important information. This sentence right here gives you an idea of how you need to treat the terminal value of the project. So instead of it simply being the final cash flow stream divided by the growth rate, okay, they're more conservative, right? So the terminal value for the Heritage business, based on, in these two projects that you're going to be evaluating, isn't going to be just the straight up perpetuity formula of final cash flow divided by the growth rate of the firm of 3%. Okay, it's going to be something more conservative, lower than their historical growth rate and lower than the near-term growth forecast for the division, right? And you have to try to figure out what that means. What assumption do you think you need to make, right? If we take the future cash flow value of that final year of project one, okay, the Match My Doll project, okay, and we divide it by the growth rate of 3%, okay, that's a pretty aggressive number, right? But if we took that final value and we divided it by the difference between the WACC and the growth rate, it's a more conservative estimation of what the terminal value of that project might look like. Okay, so give some thought to what that means as it relates to how you go about calculating the terminal value. Okay. And so now they get into the two different projects themselves. We've got the first project which is called the Match My Doll clothing line expansion. Gives you information around what some of the upfront initial expenditures look like. So in the example that we just went through in Excel, we had some initial R&D expense. We had some initial investment in working capital. And in this case, we have a couple of other items that are going to be layered into the initial capital outlays for the Match My Doll collection. It will give you some information around how they go about calculating the depreciation. it will give you information on the second project, the design your own doll project, okay? And it gives you the same type of information that you got for the match my doll clothing line expansion with initial capital expenditures, okay? Gives you information around the additional salary costs, the production cost changes, okay? So there are some differences between the two projects, and when you're in your written analysis, one of your objectives is to communicate what the impact of what are the differences between these two projects that Mrs. Harris is looking to evaluate. Which one seems to have more risk than the other project, okay? Because that's going to help you assign what discount rate you need to use, okay, for one of the two projects. And then finally, we get down to what's her decision, okay? She knows she's got to pick one of the two, right? Based upon the case, you can make the assumption that they're mutually exclusive, okay? She can't do both. She's got to pick one or the other, right? And so she's got some questions that she needs to get answered, and you are here to help her, okay? So within, I would get, so by, and I'll put this out on Moodle as well. By Thursday, you need to form your teams, okay? Groups of no more than 4 people, and just shoot me an email with who your 4 people are, okay? So by Thursday, please get your teams formed. Because what you're gonna do is you've got a written analysis, okay? The constraints, please, 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 right? Times New Roman 12, 1.15 spacing, normal margins, give me a cover page. Your valuation objectives. I apologize. Let me go back to the case study real quick, right? So she's got this decision that she's going to have to make, right? And she gives you some pro formas for each of the 2 projects. She gives you the pro forma for the Match My Doll. She gives you the pro forma for the Design Your Own Doll. Okay, so you've got revenue projections, you've got cost projections, you've got sales, general, and administrative projections. You've got assumptions around working capital, so cash balance assumptions, days sales outstanding. Okay, what does days sales outstanding represent on the balance sheet? What can you calculate based on that number? Think about the components. Remember, so working capital, remember working capital is equal to what? Current assets minus current liabilities, right? So when we're talking about working capital assumptions, we better have some info in there that relates to cash, accounts receivable, inventory, and accounts payable. And you got it. So it tells you what the days sales outstanding are, and you can back solve for what the actual physical dollars are within accounts receivable. Same thing with inventory turnover. You can calculate what the inventory value is based upon the inventory turnover numbers. Accounts payable, days payable outstanding, you can back solve for that, okay? And then it gives you what the incremental capital expenditures are year over year for each of the projects, okay? So they give you all of this basic information. And because I'm such a nice guy and I'm feeling generous, I've already gone in and created an Excel file for you, okay? Now, some of you are going to be going, Jesus, why couldn't you have just plugged in all of the answers so we don't have to do it? Well, I'm sorry, I'm not that nice of a guy. But nonetheless, I've taken all the information on those 2 exhibits, okay? And I've put it into Excel for you, all right? And then what you're going to need to do is complete everything that you see in green, okay? You need to develop the net working capital accounts, calculate what the cash is, calculate AR, calculate inventory, calculate accounts payable, all right? to determine what the annual net working capital is for the business, okay? And then calculate what the change in net working capital is year over year. Then you step into the net present value analysis. So just like we did with the example, okay? What is the after-tax EBIT with a given tax rate? Add back the depreciation, minus less, subtract out the change in net working capital, subtract out the capital expenditures to get to free cash flow. Calculate the terminal value, okay, based upon a growth rate that you're going to assume and some discount factor that you're going to assume, okay? And based upon what you found within the case, okay, within the case, sorry, I gave you 2 free answers there. I hope somebody was paying attention, right? You'll have the initial net working capital outlays, right? You were given that. If we go back to the project, the Match My Doll, right? You're told what the investment in working capital is. You're told what the investment in PPE is. So you've got that number. You've got that number, okay? Calculate what the discount factors are, okay, based upon a given discount rate. Okay, discount factors. Calculate the present value, okay? Tell me what the net present value is. Give me the net present value excluding the terminal value over here, okay? Calculate the IRR, okay? Calculate the payback, calculate the profitability index, right? And you're gonna do that for the Match My Doll, and you're gonna do it for the Design Your Own Doll. That's gonna be all your data. And your written assignment that you'll submit is going to go through and you're going to give a thorough written analysis of these 8 questions and topics, okay? You're gonna give me an overview of the case, what Ms. Harris is facing, how the capital budgeting process works at New Heritage Doll Company, okay? We're gonna talk about the doll, the industry as a whole, talk about the growth rates, talk about how the Heritage growth rates compare to the industry growth rates, whether you feel it's sustainable or not sustainable and why, okay? Look at the operating margins compared to the industry and offer up your opinion as to whether or not why some of these constraints might explain the production division's constraint of having to pick one project or another, okay? Meaning that they are mutually exclusive, okay? So maybe you calculate what EBITDA looks like, and then you look at the Heritage Doll capital budgeting constraint of 15% of that. Maybe the 15% of that only correlates to being comparable to one of those 2 projects. I don't know. Just an idea. Okay? Compare the business cases for each of the projects, right? Which business case, forget the numbers, but from a business case standpoint, which project do you find more compelling? Which one's sexier than the other one, right? Like which one seems to be nicer than the other one? Which one might deliver a nicer doll to the end consumer? Like, but before you get into the numbers, like which project that they're considering implementing, right? Seems to be a little more compelling, right? You could be right, you could be wrong, okay? The answer to question number 3 doesn't necessarily have to be the answer to question number 8, okay? But which project do you find most compelling and why, right? Question 4, calculate free cash flow, right? After tax EBIT plus depreciation minus change in net working capital minus new CapEx. I want you to spend some time thinking about this question here. Okay. If we're talking about free cash flow, clearly as we're moving down the income statement, right? And we get to EBITDA and we back out depreciation and we get down to EBIT and we back out interest and then we get to EBT and back out taxes. Clearly we know, okay, that we gotta add back depreciation because it's a non-cash item. But I want you to give some thought to why we do not include the interest payment in the calculation for free cash flow. Because I mean, clearly it's a cash item, right? Clearly we have to use some of our cash to pay the interest on the debt that we've got, right? There's no doubt that the interest is a tax item. And the interest, excuse me, interest is a tax item, that the interest is a cash item. There's no doubt about that. But why? Think about, what are we using the free cash flow for? Okay, what part of this valuation are we using the free cash flow for? What other variables are we using in conjunction with free cash flow that might already have relevance to the financing decisions that we're making as a business that flow into the interest calculation? Okay, so I want you to think about why we are not including interest in the free cash flow from a DCF standpoint. Okay, question 5, use your projections to calculate NPV for each of the projects, and then tell me which one creates more value from an NPV standpoint. You're going to calculate IRR, you're going to calculate the payback period, you're going to calculate the spread to the WACC, and you're going to calculate the profitability index for each of the 2 projects. All right, and I'll put those other 2 things in here. How do they compare to NPV as the tools for evaluating the project? Okay, so we're going to look at NPV, but we're going to use the other metrics, and you need to compare and contrast how those other metrics also could influence the decision to do one of these 2 projects over the other. Okay, and then finally, questions 7 and 8. What other information do you think Harris might need to complete her analysis? Okay, and to compare the 2 projects? And if you had any questions, what questions would you want to ask each of the 2 project teams? Right. And then finally, which project should she pick and why? Right. Your submission should include details of your pro forma projections, include details around your NPV analysis, IRR, payback, profitability index calculations. Put those in as appendices to your paper, right? And please, dear God, just try to make it pretty, okay? I love graphs, I love charts, I love things that make me smile, all right? So if I have to read 10 pages of nothing but words, I'm gonna fall off the cliff. So make it look pretty, okay? So your paper, there's no minimum number of pages. My expectation is that you will, the length of your paper will be adequate enough to effectively and thoroughly communicate responses to each of these 8 questions, as well as presenting in logical format and form how you got to the calculations that resulted in your final decision on question 8. Okay, this is due on November the 2nd, okay, which is a week later than what the syllabus has indicated. And on that same night, we will also run the capital budgeting simulation for Heritage Doll. Okay, so we'll actually get to go through allocating capital money from Heritage Doll across 27 up to 27 different projects on a year-to-year basis, with the goal of maximizing net present value in the end of this, at the end of the simulation. Are there any questions about the assignment that is due in a few weeks? This, again, this will all be put on Moodle, so you don't have to worry about keeping track of it all. I'm going to clean a couple things up and get it on Moodle later tonight.
Yeah, I have a question. Would it be possible, or if anybody would be opposed to hashing out group members now while we have most of the class together? Because for me, I know that I don't know many others in this class.
Sure. I mean, I'm also happy just to assign people to teams. If that's the easiest for everybody, I can assign people to teams. That be all right? And everyone okay with that?
That's fine with me. It's kind of hard in this virtual class to network within the class.
Yeah. So
Prof-
add that to the ever-growing list of things that are hard about virtual teaching.
Professor, that's cool. With me, this is Morgan. Libin and I have worked together before, so we were already kind of like agreed to pair up. So, you know,
Okay.
if we're looking for a third or a fourth, you know, you can assign, I would say, Libin and I to someone else, or 2 other people. But we have a good working relationship, so we wanted to continue to work together.
Okay, sounds good. I will
Thanks.
assign. Go ahead.
Professor, sorry, this is Annalise. Julie and I, same situation with Morgan. We've worked together in the past and we were planning on pairing up. So Morgan, if you 2 wanted to pair up with Julie and I, just let us know. And that would get us a group of 4. Or Professor, if you wanted to assign us to other
Oh.
people.
Hey, no, that sounds like a good plan to me. So I'll pair the 4 of you up for one team.
I would add that like Isaac and I know each other and we worked well together in the past. So if like 2 others want to join our group.
I'm making notes here. Keep talking, people. Anybody else? So I've already got one group of 4 and I've got one group of 2 from folks that have worked together before. Anybody else work together that you'd like to be paired up with? Otherwise, I will just assign folks who are remaining. Is that cool? Okay. All right. So I've got Morgan, Libin, Annalise, and Julie as one team. I've got Catherine and Isaac as another team with 2 extras coming in. And then I'll have the remaining class assigned tonight. Cool. So one of the things I would really appreciate from you guys, and I've spent some time thinking about this dilemma, and I've spoken with a couple of other professors within the program. And I know virtual learning is challenging, and I certainly know that virtual instruction has been challenging, but I don't feel like I'm quite giving you enough compared to when we would all be in the classroom together. So I would very much appreciate some maybe you know, mid-semester feedback on the course, how you feel it's going, what you feel we could maybe change for the second half of the semester to kind of get more engagement, you know, with everybody within the class. I've got a couple of new cases that I've been researching over the last few weeks that I feel might be really good for like more of a breakout session style evening. But I'd just like to maybe get your opinions as to kind of what you think is going good, maybe what some of your other professors this semester are doing to kind of increase the engagement. Because I know it's hard, like it's hard for you, it's hard for me to use the chat room, and breakout rooms don't always work, but I just don't feel like I'm giving you enough compared to what I'd be giving you if, and I don't mean like quantity of work wise, I mean more like quality of class wise, if we were all in the classroom together. Okay, so if you've got time, or if you are willing to do it, you know, please send me an email, okay, with suggestions, that something that might be working in another one of your courses that we could implement here. And just know that I'm still continuing to strive to improve the quality of the instruction in this very unprecedented modality, let's put it that way. Okay, so we'll get team formations done. We've got the case analysis that we talked about that's due November the 2nd. We ran through a much broader example of discounted cash flow analysis, okay, that related more specifically to the Heritage Doll case, okay. This Excel file will be posted out on Moodle as well for you to download to begin using to prepare for the written analysis. Feel free to ask me any questions that you might have as you start going through the development of your discounted cash flow for each of the 2 projects for Heritage. Okay. Especially if you get confused a little bit on the terminal value. Right? We spoke briefly about that during the conversation around a perpetuity a couple of lectures ago. But if you do have a question around that, please ask. And if I start to get multiple questions, I'll make sure the whole class is aware of what question it is and what the answer or response is. Right. Okay, and then we've got the midterm next week. Okay, so midterm will be all remote as we are now. It'll be posted at 9 a.m. on Monday morning. It'll be due back via Moodle through the assignment portal by 9 o'clock on Tuesday morning. Okay, you can use your notes, use the lecture slides, use the recorded videos, use the text, use Excel, use your calculator, use the internet, use whatever you need to use to finish the midterm. It'll be a case study format. Okay, so similar to like what we just went through with Heritage, I tend to design case study midterms just from scratch every semester. So it'll be a case study. And again, the content will be everything that we've kind of gone through up to this point and have built upon. Building an income statement, building a balance sheet, calculating the external finance needed, using a plug variable, calculating financial ratios, evaluating projects on a discounted cash flow valuation, project selection, and why you chose the project. Okay, so everything that we've done in this class up until this point is something that you're going to be tested on, because like we said at the very beginning, when we get to the midterm, everything builds on itself. Okay, everything is cumulative. Once we get past the midterm, then we do more discrete instruction. We'll talk bond valuation, stock valuation, and I promise you that the future value formula is going to be something that sticks with us for the remainder of the semester, even when we talk bonds and stock valuations. Okay, we'll get into security market lines, market efficiency, market hypothesis, efficient markets. We'll get into option theory. We'll get into how we go about actually calculating the weighted average cost of capital, aka discount rate. Right, and we'll have a couple of other additional supplemental cases that we'll work through at that time. Right, but from now until next Monday, spend your time studying. I have some more, I'm going to be posting some additional homework on Connect going back to the early chapters of the semester. So you'll have, obviously it'll be optional to actually complete, but I'm going to go ahead and put it out there, okay, for you to get some practice on, right? And then also I'll have some additional Connect assignments that are out there for kind of what we talked about tonight. From chapters 6, 9, and 11. Okay, again, I encourage you to do the homework because it'll give you some good practice, but it's a really good way to begin studying, okay, for the midterm. Okay? And remember, read the words carefully in the midterm. Words matter. If it says incremental, don't make the mistake of using the totality, right? Read the words and do what the exam asks you to do. If you're going to make a mistake, I guarantee you it's going to be because you just didn't read it right. That's it. Okay. Any questions? No questions? Okay. I'll get Moodle updated with everything that we talked about tonight. I'll process the recording for tonight's lecture and also get that put up onto the YouTube channel. And if you have any questions between now and Monday regarding the midterm, please feel free to reach out. We can hop on a Zoom call, we can hop a conference call, whatever's best for you guys. And again, please, I thank you for any feedback that you can provide in terms of what's working, what you'd like to see done differently, how we can go about getting more engagement, what some of your other professors are doing. Like I really value that feedback. So I'm going to stop recording our lecture now And if there's no more